Hi, everyone. I'm Addison Snell. I'm with Intersect360 Research, and I'm delighted to continue our partnership with the HPC Advisory Council. I'm sorry that we're not there in person. We'll be back in person for a future event, but I'm also grateful that we have the technology to continue to share with each other in what are challenging times in a number of ways, including for forecasting the high-performance computing and AI markets and hyperscale markets, which is a big part of our job at Intersect360 Research. In a normal year, April is a challenging time of year for us to give a presentation because everyone's hungry for us to finalize the previous year's numbers, and we're right on the brink of getting those done for our clients, but I can share what intermediate insights we're ready to say publicly at this time, which of course have really been affected by the global economic situation around COVID-19. We did get a full slate of high-performance computing research reports out last year. This was a big increase in our publishing rate, and we're going to be looking at maintaining something similar for this year. We might tweak the content a little bit based on responses from our clients. The big category people tend to think of is high performance computing market and forecast. That's the market sizing and outlook, which we segment 10 different ways here. The primary way people tend to look at is products and services. How much is servers? How much is storage? How much is cloud computing, et cetera. Vertical markets is another major category, and of course we do server shares and storage shares. That's by revenue. For the current year only, we don't forecast those because we don't want to influence the competitive dynamics between those companies. We'll measure them, but we don't forecast individual companies. Then we do major survey work around budgets and around installations. Those are the budget map survey and site census survey. It's the site census survey where we're going to take a look at our methodology and maybe change it a little bit in terms of how we're measuring the market. But we've been doing these surveys or variations on them every year now for more than 10 years. And we did release a special report on AI and machine learning training infrastructure, how much money was getting spent, and the future outlook there, looking at it both from a primary demand standpoint, as in here is a system that is dedicated to machine learning, and that's the reason I bought it. So it's distinct machine learning spending versus secondary spending, where maybe you have an HPC system that is shared for machine learning, and maybe I spent more on it than I would have otherwise because I'm altering the configuration, including something like GPUs, for example, in terms of the overall configuration. So we look at both the primary and secondary market. Also in 2019, we did a series of vendor profiles for the first time. We took the top vendors in their categories, either by revenue share or by survey share as appropriate, and did vendor profiles on each of those, resulting in 21 different vendor profiles. That's taking the top 10 server and storage companies, the top 3 processor companies, the top 3 cloud companies, some of the top networking companies, et cetera. And that's what generated this list. A few notable companies that didn't make the list. There's not an ARM vendor on here because we weren't seeing a lot of ARM shares so far, but we're hearing some demand to at least look at a company like Marvell or Cavium and put them on the list for this year. Oracle Cloud Infrastructure started to make a lot of noise last year, but they didn't have any market share yet, so they're not on here. On the server side, maybe the biggest companies that aren't on here, NEC maybe would be the next one that's not on the list. But this is generally a pretty complete list for the top competitors. And each of these vendor profiles, we look at what's the revenue share or survey share in our research as appropriate, and a SWOT analysis for each of the vendors in these categories. These are not sponsored content like white papers. I promise you from reading them, you can't tell who is or is not a client or to what level. These were done pretty independently and are good independent analyses of what each of these vendors' challenges and opportunities are in the years ahead. wisdom on forecasting. This is particularly appropriate this year. My partner, Chris Willard, who's been our chief research officer, although he's now retired, he's still my partner, and he always liked to say, when you make a forecast, it has to be bound by what's realistic, but reality has no such restrictions. And then 35 minutes ago, Katie Lewis said in her presentation, the highest error is where it matters most. Spiky data is problematic. Boy, is that true. And as soon as she said that, I had to add it into this slide on the fly. Now, she was talking about using machine learning. We're not, using AI to do our market models and forecasts. We are doing our own analysis, and it's as hard for humans as it is for machines to look at really wild data. And what Chris was talking about when he talked about reality not having any such restrictions on being realistic, the current environment is exactly the sort of thing he's talking about. We don't forecast wars and floods and pandemics, and they certainly have a major market effect. And we are endeavoring to revise our forecast for 2020. In fact, we've already given guidance, and we're going to narrow that down more specifically over the weeks ahead as we release a more precise forecast to our clients. But it does get tricky. Now, before we went into the current pandemic, this is what our forecast looked like. In fact, this is what we published last year, that we were looking at close to 7%, 6.8% compound annual growth year over year over the course of the forecast period. It looks fairly smooth, but every segment within this, the product and services segments you're looking at, the vertical markets, the different geographic regions, the different categories of servers from entry level up to supercomputer, all have independent growth rates that add up into this overall picture. And in fact, you can see cloud computing, which is the green bar second from the top, is clearly the high growth area that we are forecasting in this space. That's where we're seeing strong double-digit growth year over year. It really had its initial breakout year in 2017. That was when we really saw the high growth start to kick in. Machine learning probably contributed to that a little bit, or just the excitement around AI, but that wasn't, I don't think, the biggest contributing factor. I think the two biggest, in fact, I don't think it was in the top two. I think the two biggest contributing factors to really getting the growth rate on cloud going were, first of all, a maturation of license models that made it easier to move ISV or independent commercial licensed applications, to move them to cloud computing in a way that felt economically viable for the companies that were doing it. And the other key factor, I think, is a maturation of the service community around cloud service providers, not just the clouds themselves, but the intermediaries like Nimbix and Rescale and Cycle Computing, which of course got bought by Microsoft Azure, Uber Cloud, other things like that help make it easier for HPC organizations to start migrating portions of their applications over to hybrid cloud environments. And almost all of these are hybrid clouds. We've seen very few experienced high-performance computing users who say, that's it, we're not going to run anything in-house or on-premise anymore, everything's going to move to cloud. And that's not because they haven't heard of cloud or haven't seen the value proposition. It's because most of the time that wouldn't be cheaper. Most high-performance computing users are pretty experienced at running at a high utilization rate in-house, and it's not more economical to shut that down and move everything to the cloud and rent instead of buy. If you're going to run at a high utilization rate, it's generally more economical to do in-house. Now, that's not to say that cloud doesn't have a role. A big thing that we write about with respect to cloud is that we would like to see the cloud value proposition start to mature beyond arguing over what's cheaper, and start to position cloud as a premium service for some situations, particularly looking forward into future workloads and future technologies, and use cloud as a test bed where it's inefficient to do that in-house. I can't buy a little bit of everything, figure out what's next, and then move it up. Using cloud as a forward-looking test bed for the future direction of high-performance workloads, matching those to emerging high-performance technologies ought to be the sort of premium cloud service that the major cloud providers can offer in order to continue to grow at that high growth rate. That said, we're continuing to see strong budget outlooks everywhere, and we continue to measure that. Our most recent budget map survey ran over the course of the last couple of months, really going just before the pandemic broke loose. This survey was in the field in February before everything became big news. We did hit a follow-up question to respondents asking about COVID-19, but even then, talking about that being a month ago, this has been changing so fast on a week-to-week basis. It's hard for people to know exactly at a survey level what was happening with their budget. So consider this to be pre-COVID-19 answers with respect to what's going on with their budgets. When we looked at what the effect was from 2018 to 2019, what we saw was a lot of up budgets and very few down budgets. And when we weight that by economic sector, this data is consistent with the 7% forecast growth year over year, 2019 into 2018, again with commercial segments growing faster than public sector. But public sector has really recovered. If you go back to 2-3 years ago, even there had been several years before that where public sector was flat, driven by government austerity measures, Eurozone crisis, and then academic tends to follow behind that because so much of academia is grant-driven that it's hard for academia to have a big growth year when government's flat. That's really recovered now. Commercial segments were still projecting a higher growth rate. We also had the same question about what do you expect 2019 into 2020, again, pre-COVID-19. And there the weighted average was actually a little better. Weighted average was looking at close to 8% growth. We might have even looked at putting a little more growth into the forecast, all other things being equal, based on positive survey responses, take it from the 7 up into 7+ range. But really, when we now look at what's going on with COVID-19, we had to get into revising our 2020 forecast guidance. The solid line that you see there was our pre-COVID forecast. Now, the 2019 budget data that came in was consistent with our previous forecast. We have not yet finalized our 2019 numbers, but I have no reason now to tell you that it's going to be markedly different from where we forecasted. So consider that forecast to be accurate for now. Let's just put it on that line, and we'll release final numbers to our clients soon. But 2020, we're now expecting to be well off of our previous forecast guidance. And that's even after the people had been saying their budgets were going to be up. Now, the first thing that happens is you wipe out the growth that would have been there. And you could wipe out all of that growth and just get down to a flat market. I think flat is really the best case scenario that we were looking at. We're already several weeks from when we publish this to clients, and we get new data or new information on a week-to-week basis, mostly in terms of how long we think the economic impact from COVID-19 is going to last. Is it going to be something where we're all back to work next week, or is it going to be next month, or is it going to be 3 months? Is it going to be 6 months? The longer that goes, the more of an effect we see here. And we were really seeing flat as the best guidance. And I guess really, if you look at that top bar closely, there's a slight chance we could see some slight growth from 2019 to 2020 in the best of all cases. But I think more likely we're looking at a significant drop from 2019 into 2020 on the order of down about 6%, which is well below, that's now about 13% below where we thought the line was going to be So there's two ways to look at it. One is what's the drop from 2019 to 2020 year over year. Another way to look at it is what's the drop from previous expectations to current expectations, which is a farther drop. In order to do this, we really looked at different methodologies. We looked at a vertical market segmentation. We looked at a product and services segmentation. We looked at a geographic segmentation. Out of all the ways that we looked at it, the vertical market segmentation really wound up being our primary guide to go through market by market and look at what we thought the expected impact on that vertical market was going to be. As much as we like to think of high performance computing in terms of return on investment, and I invest in HPC now and it has a positive impact on my revenue in the future, and that's true to an extent. That's why we buy HPC. When you look at short-term indicators, the much stronger indicator is that my revenue this year determines how much I spend on HPC next year. And when a company's revenue goes down or contracts or they're losing money, particularly if their profits go down, then their spending contracts in all areas. Now, it's easier to look. Now, we start by looking at that from a budgetary standpoint, but then remember, within a budget, there's different effects. If all of a sudden a company said, well, you've got to take a 10% haircut on your high performance computing budget at the budget level, reduce spending by 10%, then it won't all be equal within that budget. The first thing that people try to do is maintain their current operations. And that's things like, well, staffing, I'd rather not lay anybody off, and operation of my existing HPC resources, which is going to be things like power and cooling, co-location expenses, things of that nature, are harder to trim out of an existing budget versus things like new purchases, new hardware, new software. So to the extent that power and cooling and staffing are not represented on this line, when we talk about revenue in a market, we're generally looking at product and services spending that's external, not internal spending on staffing, power, cooling, which we also track, but that's not part of this picture here. The existing operations costs should be less affected in a recessionary time with a sudden budget cut than things like new purchases, which tend to get deferred. So when we do see a 10% cut, just to take an example, if we took a 10% cut in budget, we would expect to see less than 10% effect on things that are existing, like operations, like staffing and power and cooling, but a greater than 10% effect on things like new server purchases. So that's a long way around of saying we've modeled this very carefully from different segmentations, and it's not going to be equal from one area to the next. And we have released a report on this with pre-release guidance on the effect of COVID-19. While the overall market is going to be down, some segments are doing better than others. And that's included for vertical marketing. Government research, pharmaceuticals will be relatively insulated from this. And in the best case scenarios, pharmaceuticals or even public sector research could beat not only 2019, but could beat the previous forecast. We could see an increase over and above what we had been forecasting for those segments. We were looking for 5% growth and got 7% growth out of those segments. That's an example of what could happen in the best case. And when I talk about best case versus worst case here, the primary variable there is how long this lasts and how long before we get back to more of an economic stability. Now, if some segments do better than others, then there are some segments that do worse than others. Oil and gas, we were already seeing a depressed price of oil before going into COVID-19. And now, as of last week, oil is doing even worse than it was when we went in and forecasted. I was just having a Twitter conversation with Shaheen Khan about the price of oil futures going negative, and that being unprecedented, and what that means for the for the economy. I'm just going to take a sip of water. Other areas that we think are going to do poorly, large product manufacturing, which is mostly automotive and aerospace, that's really getting hit. Entertainment is getting hit. So a lot of the commercial areas outside of pharmaceuticals, this is interesting because those commercial segments have been some of the big growth drivers in recent years, but now they're also going to be the harder hit. And we're going to see a lot of public sector research coming to save the day. Those have been the slower growth areas previous to this, but now are going to be some of the more insulated areas going through this forecast. Now, I talked about new purchases being in the product and services area, one of the areas that does the worst. I think if you look at the server forecast, for example, the new purchases of new HPC server hardware should be the hardest hit product and services segment in 2020 as a result of these, as a result of the budget pressure. Conversely, the segment that will do the best out of anything this year is going to be cloud computing. Cloud does very well in times of uncertainty, and there's a quote from the report there with respect to cloud computing. When I don't know how things are going, that's a big argument in favor of rent versus buy. And it's really the one area where we're certain of growth above and beyond what we were already forecasting for this year. We already had a high growth rate for cloud. We confidently expect that cloud will go over and above that high growth rate this year, particularly as purchases get delayed to the extent that there is a need for increased cycles. Well, cloud can absorb that when purchases are pushed out or canceled. So cloud not only handles the spike in demand for example, for research related to COVID-19, it also helps bridge the gap when there are acquisition cycles that get delayed. So cloud should see a very high growth rate this year, but overall not to the extent that that's going to be the savior for the market that keeps it up on the line. Now, can I go back a slide? I can. Going back to this previous slide, then the next question is what happens next into 2021, 2022, and we haven't released guidance on that yet. We're waiting to see how long this lasts, and the fundamental question is, when the revenue is lost, to what extent is it lost versus deferred? And we have some previous examples of this. We saw this happen most recently in the storage portion of the market a few years ago when we had severe flooding in Southeast Asia that wiped out the storage supply for about 6 months. What we saw there was that mostly, not entirely, but mostly demand was deferred rather than canceled. So we saw an echo where there was a spike above the previous line as all the demand came back all at once, and then it started to level out. The previous time we really had a recession like this in the HPC market was 2009. And there we had a mix where, yes, some of it came back, but there was also some demand that was just lost. So you couldn't really take all the excess revenue out of 2010 and 2011, shovel it back into 2009, and completely fill the hole where there wasn't a loss. Here, I think, if it had been a really short-term thing, the first thing that happens is that things get delayed. To the extent that you have companies losing revenue, losing profits, that will increasingly go to losing money they spend on high-performance computing and other areas. So the initial effect that you have is a deferral, and then it starts turning into lost revenue, and that will extend the longer the pandemic lasts, or I should say the longer before there's a resumption of economic activity and restoration of revenue for affected companies. So hate to be doom and gloom, but there's likely to be lost revenue. That's not to say there won't be some echo up above the line in 2021, and we're going to have to model that out. but we might be in a situation where as analysts, we have to keep revising the forecast on more than an annual basis as we get additional information. This is the vertical market segmentation. Now, this is based on 2018. We haven't released it yet for 2019. It will not vary much 2018 to 2019. The arrow on, well, first I'll go around the wheel quickly for those who aren't familiar with this slide. Academic is one big chunk at 17%. Yes, there are many different workloads within academia, but to the extent that academic labs tend to be mixed workload, it's hard for us to separate that out and say this much is biosciences or this much is finance, whatever. It's they're academic labs that are at 17%. We can do that at a workload basis, but not at a spending basis. Then government, which is more than just U.S. government, of course, is 25% of the market, although the U.S. is disproportionately represented in this segment. And that mostly splits out between security and then research labs. The difference on this chart between national research lab and national agencies have a single point of focus, like a weather facility like ECMWF or NOAA or something like the National Cancer Institute. Those would go into national agencies versus something general purpose like Oak Ridge National Labs or Lawrence Livermore National Lab. Those are going to be the national research labs. And then more than half of the market, 58%, is commercial use cases. Large product manufacturing there is really automotive aerospace for the most part. They're separated out between that and consumer product manufacturing. That's going to be your golf clubs and bicycles, and Procter & Gamble is the poster child in that segment. Financial services is either the largest or the second largest segment, depending on your appetite for combining large product manufacturing and consumer product manufacturing into a single manufacturing segment. If Toyota and Procter & Gamble are in the same vertical market, then manufacturing is the largest. If they're not, then it's the second, then financial services becomes the largest. And that's a matter of taste and how our clients like to divide their sales forces. So we present it here, separated out just for the additional detail. Chemical, which has an arrow on it there, that's not chemical like biochemistry, like molecular modeling. Those are down in biosciences. Chemical here, I should change the label to chemical engineering. Those are pretty much the plastics and polymers segment, your Dow, DuPont, BASF, 3M, those guys. And they have an arrow on them there because prior to COVID-19, that's the highest growth rate forecast in our segment. So just looking at it strictly from a demand standpoint, we're seeing a 5-year growth rate in chemical engineering that from a demand side should be the highest growth rate among all the vertical market segments. Financial services has an arrow on it because it's the one where we've seen the most discrete spending on dedicated to AI and machine learning. People talk a lot about personalized medicine and self-driving cars. You're going to have personalized interest rates first before you have personalized medicine, I promise you. Why? Because there's a lot of money in it. And where there's money in it, it's worth investing in. Solving the regulatory environment around that is actually a bigger challenge, I think, than the computation, although the computation is certainly formidable as well. So we looked at each of these vertical markets in coming up with our pre-announced guidance on COVID-19. We ran around this wheel and really looked at each industry segment and how much we thought how much they were spending, what kind of revenue impact we thought they might take, and then compared that to our geographic segmentation and our product services segmentation to see if we thought we had a consistent view with respect to at least a range of guidance for where 2020 would go. Sources of HPC applications also becomes interesting. It's really worthwhile to note when putting together a high-performance computing strategy that what that strategy looks like should really vary by segment, not only because they have different needs or different workloads, but the constituencies of those workloads can be very different by segment. Here we have 11 different application domains. Now, this is not necessarily the same as vertical markets because an application domain like computational fluid dynamics appears in multiple different vertical markets. So vertical market is what kind of organization is it, and application domain is what kind of application is it. Those are correlated in many cases. An energy company runs a lot of geophysics applications, for example, but they're not always one-to-one. In fact, going back to the previous slide for a second, notice that we don't have weather as a vertical market. It's because it's not a vertical market, right? Different kinds of organizations can run weather and climate simulations. To the extent that it's done by a national agency like NOAA or ECMWF, then it's part of national agencies there. In fact, those are probably the largest component of the national agencies. But then we also see a lot of national research labs like NASA or JAXA who will do weather simulation as part of their overall work. Actually, or Oak Ridge will do it as part of their work. So we see it there. We see it within national security. Fleet Numerical of Monterey is underneath the Navy, but does a lot of weather and ocean and climate simulations. We see it in academia, and we even in some commercial areas will see certain weather and climate modeling. But we do have it as a application domain. The big point of this chart is that if you look at open source versus in-house versus ISV, they are very different segment by segment. Is this right? Yeah. So as we look at these different areas, we see that some, like for example, finance or oil and gas have a really high proportion of in-house applications, whereas others like the engineering-driven areas like CFD or what's labeled here as engineering to capture a lot of CAE are dominated by ISV applications. And then some like biosciences and chemistry are really dominated, and weather are dominated by open source. I was just fumbling for a second because I realized I accidentally grabbed an older version of this slide, and bioscience is the two segments that are roughly equal, in-house and ISV, are their labels are swapped from each other. So but the segments are about the same size, so it doesn't matter much. I was just bothered because I had an old version where I hadn't swapped those labels yet and fixed them. Other than that, these charts are all correct. And this is another big thing that we track as part of our site census research. As we look at things like new processors coming into the market, this is really important because as we look at the dynamics of, say, AMD coming into the market with EPYC, or who's using GPUs, or where are we going to see ARM or Power or FPGAs, really the performance of the processors is one thing, and it's very interesting to people to see how those get benchmarked. But those are the initial battles. The big war is going to be fought in software. And if I don't have my software optimized for that processor, I'm not going to buy that processor, even if it's 10% faster. And in some cases, you have to see a dramatic and confident increase in performance before you can start getting software ported over. Now, these are looking at end user applications. That also applies to all the different types of middleware operating environments, which we also have charts on. And recall that Intel is the #1 dominant provider of middleware for the market. So an entrant like ARM or AMD has to not only win away the application segments, but also have a robust set of middleware for attacking what are currently dominant Intel installations. It's not impossible, but it's worth thinking about the fact that really the software environment is significant. This is what NVIDIA has done very well with CUDA. Software accelerators have been around for a long time before GPUs, but it wasn't until GPUs and the work NVIDIA did with CUDA, that you really had a very approachable programming environment for them. That was one of the major hurdles that NVIDIA managed to address that got GPUs the adoption that it did. So as we look forward, HPC has really gotten into a lot of different areas. We see cloud, we see analytics, we see AI as major parts of these environments. We still talk about high performance computing because at a budget level, that's still an identifiable budget that we can track as analysts. And a lot of these areas then get sucked into HPC. Not all cloud is HPC, not all AI is HPC, not all analytics is HPC, but when they become part of a high performance computing budget, that's when we can start to track them. And we track them there from a spending or budgetary standpoint. That's important historically. Look at what happened with big data with regard to analytics. It's hard to remember all the way back to 6 years ago, but just as AI became the dominant thing that everybody talked about for the last 2 or 3 years, we had 2 or 3 years where big data was all anyone wanted to talk about as the new HPC. And it's not that data science or analytics didn't become important workloads. They did, but we saw very little budgetary effect at the top level over the course of that. And we were among the minority of analysts who did not say, here's this huge separate market to go attack. We had very unpopular research that said big data is not a separate market and it's not a separate $50 billion opportunity. There's not a distinct high performance data and analytics budget where money is being spent. And if you followed other analysts who talked about the size of the big data opportunity, you would have a lot of big data appliances or even whole separate business units that went after big data, and almost all of those failed. It was actually bad guidance. Now, as we look at AI, we're trying to take that same kind of careful approach. Is it a distinct budget opportunity? And here we find that it is in a way that's unlike big data. We found that in 2018, there was a $6.7 billion primary dedicated to machine learning, where, as I was saying, that's budget that's for a machine that's specific to machine learning. That's why I bought it. That's what it's doing, $6.7 billion. Now, most of that came from hyperscale, 84%. That's the big cloud scale companies that are buying into machine learning. The rest was mostly around HPC. What we found is that currently, as of our most recent fresh budget map data that just came in, over 60% of HPC users have implemented machine learning, and only 10% say they don't have any plans to do so. Now, that's usually on the same hardware, often with changes to configuration. Compared to last year's survey, there's a significant change in budget as a result of machine learning, and that starts to look like this. Now, first, here's the difference between primary spending and secondary spending. This is primary spending 2017 to 2018, mostly in HPC, or rather mostly in hyperscale, but the bigger growth was in HPC, and we're going to see that continue into 2019 based on these budget trends. When people have said they are doing machine learning, we ask, well, what's the change in your budget based specifically on the incorporation of machine learning? And on the left, that big chunk, relatively stable, that's where it's flat. Then we have only 3% of respondents that were marking a significant decline beyond 5%. But then we've got 40% that are saying moderate increase of 5 to 20%, 7% who have a sharp increase of 20% to doubling, and 5% who are doubling or more to their budgets. Now, by the time we add this all up, this doesn't mean HPC budgets are doubling, right? But we are seeing a significant effect of machine learning on the HPC budget, to the extent that it will have a measurable effect on our market model and forecast going forward. Now, this has to be netted out against COVID-19 and a lot of other stuff, but this is one of the big trends that is buoying the budget going forward and will have an effect on the market. So looking forward, what to watch for in HPC short term, this year, next year. Well, first of all, there's COVID-19. Okay, fine. We've got to deal with that, and I already spent considerable time on that. But beyond that, the big trend that we're watching from a trend standpoint is that the battle between processor architectures is being fought in software, and we have to start tracking what's going on with ARM, what's going on with AMD, what's going on with GPUs relative to Intel, and how secure is Intel's hold on a lot of this market, really. Over the medium term, a big thing I'm looking for is to what extent machine learning techniques are integrated as part of traditional HPC applications as opposed to separate from. I'll give you two examples here that I like. One is iterative in terms of AI in the loop. We've talked about things like simulator in the loop or engineer in the loop for decades now, but we haven't seen it really take off because of the human latency involved there. But, well, what about AI in the loop? If as we heard from Nick in the morning presentation, if AI is already learning games like Go and poker, if we can teach it the rules of those games, can we also take a step and teach AI the rules of a different game, like optimize the airplane wing? Here are the rules. Here are your constraints. Here are your materials. Now go play the game and see what AI comes up with in terms of iterating models to do something. It could be, optimize an airplane wing. It could be, find the proteins that interact. It could be, predict the hurricane. There are a lot of ways that we could have AI-guided HPC, not as a replacement, but as an iterative part of the process. And note that this does not get rid of the engineer. What we get a lot of is target reduction. And then you get the real engineering going on to vet the strategies that AI suggests in terms of an ongoing part of the process. In the longer term, for the second half of the decade, I think the most significant thing that's going to happen is a revolution in high-performance storage. We're already seeing, by the way, an increase in tiering driven at both ends. On the node, we're seeing an incorporation of on-node storage again. Back when clusters were new, it was very common to see system disks as part of a cluster node. They would get used for the operating system and for a certain amount of scratch. Over time, those migrated out of cluster nodes, and we'd see a lot more diskless nodes. Now they've come back in again, but not with spinning disk, but rather with flash. All different types of flash and NVMe SSD components are now getting incorporated again into the node for different storage purposes. At the far end, at the archive, we're seeing not only a maintenance of tape is still there, but a proliferation of maybe a nearline archive or warmer archive. These typically aren't tape, but are usually disk-based. So where we used to have tiered storage or hierarchical storage management or information lifecycle management, when we talked about those in the past, it meant you had two tiers. You had disk and you had tape. Now you might have 5, 6, 7 tiers, and cloud can be a tier of my storage, by the way, that's entirely separate. So I think when we start looking at high performance storage in the second half of this decade, it's going to be not so much about having high bandwidth to one storage tier like with a parallel file system, but more about how you manage data moving between the tiers, and especially can I promote data to a faster tier before it gets called on, which is really looping back to my other example about incorporating AI into HPC. That should be a perfect use of AI, doing storage modeling and trying to promote data before it gets requested. That's not really a ridiculous ask. Hyperscale companies are already doing that. And if that happens, I would say it's likely to be an object orientation. People used to laugh at object storage as part of high performance computing because of the overhead. I don't want to pay overhead for anything in HPC, but just as we're starting to see virtualization, for example, come into HPC through containers, you would never talk about virtualization in HPC. I don't want the overhead. Well, what about this container? Well, here's an object orientation that might make sense, because if I can really promote data faster or predictively in a prefetch kind of way on a storage architecture because it's object, that becomes now high performance instead of low performance. And that's a possibility for how storage could evolve by the end of the year. All right, I've run through all of my slides, and it should have a little bit of time left to take questions. Thanks very much.
Thank you, Addison. And yes, we do have a couple questions. So the first one is, what is your order of magnitude guess for the hardware sales of quantum computers in the year 2030? Do you think it is over or under $1 billion per year?
I don't have a model for sales of quantum computing in 2030. I will say that quantum computing has been 10 years away for the last 20 years. So it's now more than zero. I think there have been 4 or 5 that are actually sold. More than $1 billion. Let me think about it. It's certainly not within the next 5 years. 2030 is a long way out to try to predict. And what I'll say, rather than predicting will it be over or under $1 billion in 2030, is I'll say what would have to happen in the next 5 years. And what will have to happen in the next 5 years is I think the best implementation right now for access, I'm not saying it's the best model for quantum computing, but the best model for access has been what IBM has done with IBM Q and doing that as part of an IBM cloud to allow people to test. If that were coupled with education around quantum computing, like paid seminars where part of what you pay for is you get to play around with it as part of a cloud, I think that's the model that we need to see going forward, and that should be something that's easily replicatable by companies like Google or Intel or others who are really playing with it. It's that kind of taste model that should get things going. That said, quantum computing and the applications it's really good for are going to be highly specialized throughout the 5-year forecast and then through the end of the year. So now that I've talked for long enough, I'm going to say under $1 billion by the end of the decade, and that's not due to a lack of readiness. It's due to the specialized nature of the application and who's really ready to buy one to dedicate to specific applications. I think the market for that is under $1 billion even in 10 years.
Okay. And looks like it could be our last question. Once the pandemic is over.
Brian, before going to another question, Edison, are you looking at quantum computing as something for running a complete application, or potentially quantum computing can start as essentially accelerator and accelerate specific algorithms? So it's not specifically to a specific application. Well, it can be a more...
Yeah, that's a fair point, Gilad. And you can have quantum components in traditional applications, but we haven't seen yet what that looks like. So even to the extent that someone could have a traditional architecture with a quantum accelerator component, then you'd be looking at, well, how much am I paying for that additional component? We could see those, but now do you want me to count the cost of the whole computer? Or do you want me to count just the cost of the quantum components? If just the quantum components, I'm going to stick with my under $1 billion answer.
No, I'm not arguing on the billion or not billion, but just putting a note here that the quantum computing can be used as an accelerator rather than
sure,
just
of course.
the whole system for an application.
Of course. And thank you for the point.
Okay. Once the pandemic is over, what do you think is a reasonable expectation for the per year improvement in price performance ratio of double precision floating point?
So rather than saying once the pandemic is over, I'll reinterpret the question to say, regardless of the pandemic, pretending it never happened, what's the trend line for price performance improvements? And that's really a code for, where do we stand with Moore's law? Um, and Moore's law has almost been holding up in it from a purity standpoint in terms of transistors per area if you'll let me cheat and stack them, right, and go 3D with it. It's almost been holding up, but the realized performance that we get out of that has been going down. And if you really mean realized application performance, then there's going to be a very wide spread of what's going on because it's so easy to get distracted by what goes on at the top of the pyramid. And here's my first application that's really running at exascale, but most applications don't get those benefits. And I think for the majority of commercial markets, you'd be better off talking about how do we get those applications to petascale than how do we get some applications to exascale. There's a big gap there now. I'm not going to comment on what I think the real line is. I think there's plenty of charts around that, and we don't cover that in our research.
Okay. And how do you see COVID affecting NDR networks and other roadmaps?
Well, roadmaps only get affected to the extent that it delays development. So if you're at a technology vendor and you see a reduction in revenue because people are ordering less, and then you have to cut R&D and it pushes a project out, that's kind of a tertiary effect. I don't expect many roadmaps will really be delayed. I think from smaller companies, especially if you have something new that's developed from a startup, that's where things are really in jeopardy. Can those companies keep up with the cash infusion that they need? But from larger companies or established roadmaps, I don't expect to see much in terms of roadmap delays. Now, that's in a current environment. Ask me again in 2 months when we see how this is playing out and are we all back to work yet?
Okay. Well, thank you, Addison.
My pleasure. It's always great to be here. I love these events, and I really appreciate people being online and listening, and also to Inside HPC for posting the presentations. Big help.